Hey folks, thanks for tuning in to our Mortgage Market Guide weekly recap. So up on the screen, I have a 30-year fixed mortgage rate going back history for just 6 years or so. Because as we've been talking in previous videos, 2022 has shades of 2018, where the backdrop was a hawkish Fed, a desire to hike rates multiple times, and a desire to shrink or remove some bonds from their balance sheet. Well, here we are on a Friday, and a surprisingly hot jobs report with hot hourly earnings, upward revisions, an uptick in the labor force participation rate is certainly now going to embolden the Fed to be more hawkish, and in our eyes here at MMG, pretty much cements the rate hike for March. So what does that mean? Well, when we talk about shades of 2018, here's what happened in 2018. Interest rates ticked up throughout the entire year over the course of rate hikes. So you can see here, we started the year at 395, and look at how they moved up pretty quickly. Never went lower, right? And then finally, you got to the end of the year, November, and what happened? The Fed overcooked it. They signaled that a rate hike was coming in December. They did it, and mortgages peaked at 5%. But you can see we essentially went from 4% to 5% over the course of 11 months. And then it was an extra rate hike, which kind of put the nail in the coffin. And then they spent the rest of 2019 actually unwinding it. And then right here is when they actually, in July, they actually, sorry, get down here a little bit more. They actually cut rates here. So you can see we ended up lower. A year later, we ended up lower than where we were the previous year. But we had to endure an increase in rates, the Fed backing off of it. So now, here's 2018, or I should say, here's 2022, and we start the year at just above 3%. And you could see it's moved higher quite a bit. We've already moved a 0.5%, and I could see the 2-year paper moved really high. The 2-year bonds moved high, 2-year notes, because that's indicative of Fed activity. The 10-year note at 190 and change, you have to put 195 as a number to watch closely. We get above 195, things are going to get weird and different very, very quickly. We're also looking at the German Bund at 20 basis points. That's a 3-year high. So global yields are rising, and we have this central banks around the globe trying to be very, very hawkish and hike a lot of rates. And if they are able to do it a couple of times without slipping the economy into any kind of sustained slowdown, then we should expect higher rates in the weeks and months ahead. So it's a tug of war, and it's something that the Fed's going to have to be very, they're going to have to thread a needle, because a lot of times in the course of history, the Fed hikes rates. They usually do it too many times and creates a slowdown. And that could happen next year. But for right now, we have a market that's very spooked out by central banks around the globe, like Bank of England raising rates this week. Now you're going to have our Fed probably be a little bit emboldened to keep that hawkish position that they have put in place. So I hope this finds you well. Have a great weekend. Be safe, and we'll talk to you soon. Bye for now.